Hello students, welcome to BYJU'S IAS. In today's live session, we will have a discussion related to some of the very important economy related articles which have appeared between 16th to 30th June 2021. Now before I begin the discussion, last week I had asked one question, okay, that was related to which was the first mutual fund company or entity which was started in India. I have gone through many of your comments and most of you are correct. When I say most of you, some of you have answered with respect to non-UTI mutual fund, which was SBI. That is correct when the question is non-UTI mutual fund. And when the question is which was the first mutual fund in India, it is UTI. Although remember, it was set up by Government of India with the passage of an act of the Parliament. Okay. With this particular point, let me start the discussion for this particular week now. The first and the very important article for your exams will be the microfinance industry or a microfinance sector. Now, very recently RBI has come out with a proposal or a framework to regulate this particular microfinance institutions. Henceforth, I will be using an acronym MFI, and whenever I say during the course of discussion today MFI, I will be referring to microfinance institutions, not mutual funds. Please do not mistake it. Now, first and foremost, what do you mean by microfinance? Let's start with that. First we will understand the basics, then we will understand what has been proposed by RBI. Microfinance basically will have following features. First, very small value of a loan will be given under this. Okay, so the amount of loan that is given, right, that the value of the loan will be very small. First point. Second very important point, these loans are not given to everyone in the economy or not everyone in the system. They are targeted. Targeted to whom? Targeted to poor households. I am using the term poor households, but in the textbooks or in the magazines or even in the RBI website, they will generally say that they are going to target low income households. Is it okay? Low income households. That is the second very important feature. Third very important feature, the repayment that is done by these particular borrowers, there is a flexibility attached to this particular repayment. What do you mean by flexibility? The borrower will decide when to make the repayment. Either he can make it weekly or monthly like this. That kind of a flexibility is provided to the borrower. And most importantly, since these are the small value of loans given to poor households or low income households, collateral is not collected. Remember this, most of the loans which are provided under this are for poor people. So, collateral will not be collected under these particular microfinance. Now, over a period of time, microfinance has been one of the vehicles or one of the instruments which has been used by government in terms of formulating policy, by RBI in terms of promoting financial inclusion. Because generally under this, have a look at this. To whom are we targeting these particular loans? We are targeting these particular loans for low income households. So, when we are giving these particular loans either directly or indirectly to these particular or these kinds of borrowers such as small help groups or self-help groups like this, we expect them to utilize these particular loans and move out of poverty like this, increase their income, increase the standard of living. And because we are providing access to credit through this particular concept of a microfinance, we also are expecting the concept of financial inclusion to be achieved. So, the idea or the concept of MFI is very important for Government of India in order to achieve multiple policy objectives like this. Now, over a period of time, what has happened is lot of financial institutions such as scheduled commercial banks, regional rural banks, cooperative banks, and even microfinancial institutions have cropped up in India, and they have been providing these kinds of a microfinance to these kinds of borrowers. RBI in the year 2010 basically set up one committee. Please remember the name of the committee, Malegam Committee. Remember the name of the committee, this is very important. Malegam Committee, YH Malegam Committee. And based on the recommendation of YH Malegam Committee, RBI basically introduced a new type of lender under the microfinance. These were referred as NBFC microfinance institutions, NBFC MFI. So, in addition to scheduled commercial banks, RRB, so on and so forth, now there is a new category of a lender specifically for microfinance, that is NBFC microfinance institutions. Now, whatever regulations have been implemented, whatever guidelines have been issued by RBI in terms of a microfinance in India, these are mostly affecting or mostly regulating these kinds of lenders. For example, I will discuss this further in terms of regulating the rate of interest, because basic idea of a microfinance is what? Giving loans. So, whenever you give loans, obviously the lender will have to charge a rate of interest. So, in terms of lending, when you charge a rate of interest, RBI came out with certain guidelines based on Malagam committee recommendation itself. But this particular regulation on the rate of interest was applicable to microfinance institutions, that is NBFC, MFI. But the same type of a microfinance which is provided by the scheduled commercial bank, the rate of interest that is decided on this particular loan was left to the bank itself. I can understand the difference here. In case of NBFC, MFI, RBI gave a guideline. In case of SCB, giving a same type of a microfinance, the SCB, scheduled commercial bank itself used to decide the rate of interest. So, over a period of time, what has happened is, these kinds of regulations which have been implemented by RBI are found to be basically inhibiting the growth of this particular microfinance institutions. So, to address many of these particular issues, RBI very recently has proposed a new framework to regulate this particular microfinance industry or microfinance institutions. Now, earlier what was the proposal, or earlier what were the regulations? Then we will compare that with the proposal so that it is clear to you as to what RBI is trying to do here. First and foremost, earlier understand this very carefully, RBI basically said we will regulate the rate of interest on the microfinance loans which are issued by these particular NBFC MFIs. Now, what kind of a regulation was implemented? Please remember this. RBI basically said whatever is a cost of funds, whatever is your cost of funds, above and over this particular cost of funds, you will be allowed to charge a maximum 10% rate of interest. Now, what do you mean by this? Imagine here is a microfinance institution. It has taken money from the market and it is about to use this to give loans to a borrower in the market. Now, whatever is the rate of interest which the microfinance institution will pay on this particular money. For example, imagine there is a XYZ, XYZ has taken money from someone, and on this particular money or on this particular deposit, XYZ will be paying, let us say, 4% rate of interest. This particular 4% rate of interest is nothing but the idea of a cost of funds here. So, understand this, whatever is your cost of funds, add to that 10%, and that will be the maximum amount or maximum rate of interest that will be allowed to charge on these particular loans that you are giving. But again, within this also, whether your total loan books consist of 100 crores or more than 100 crores, up to 100 or more than 100 crore rupees, based on that they had two different rates. For example, they basically stated, if your total value of loans that you have issued have crossed more than 100 crore rupees, then maximum rate of interest that will be allowed to charge will be cost of funds plus 10%. And if it is up to 100 crore rupees, then the formula will be changed to cost of funds plus 12%. But again, there is a complication, just wait for it. This or, follow this, this or 2.75 times the average rate of interest that is charged by top 5 microfinance lenders in the market. Is it okay? I will repeat it again. The rate of interest, the regulation was done like this, either this or this, whichever is the lowest one. Is it okay? And this particular regulation was applicable only for NBFC MFIs. For rest of these particular SCBs which are also lending the microfinance loans itself, this was not applicable. Now, what is the problem with respect to this? The problem is this. Imagine two examples here. Imagine there is one scheduled commercial bank and there is one microfinance institution. The scheduled commercial bank, because it has got a larger asset base, it has got huge amount of lending in the market, it has a better the image in the market, will be able to raise the money at a lower rate of interest. What do I mean by this? Imagine here is a bank which has raised the money which it is using to lend in the market. Let us assume microfinance loans itself, but the rate of interest that the bank will be paying on this particular money is, let us say, 2% or let us say 3% even for that matter. And after 3% it will add operating expenses, profit motive, so on and so forth. and it will decide to lend, let us say at 15% in the market. But on the other hand, here is a microfinance institution which has borrowed the same amount, let us say from the market, but in terms of asset size, in terms of profitability, in terms of security, obviously this particular microfinance institution will be viewed as a lesser one compared to a scheduled commercial bank. So when you are giving loans, imagine you are the lender here, you are giving 100 rupee as a loan to a bank, scheduled commercial bank, and same 100 rupee as a loan to a microfinance institution. You will charge a higher rate of interest on the microfinance institution. Why? Because of various features that we have discussed earlier. In simple terms, what I am trying to say is simply this: the microfinance institutions were able to raise the funds, but the rate of interest on this particular money which was paid by the MFI was higher. Cost of funds for MFI was generally higher compared to a scheduled commercial bank. The problem arose when the rate of interest was decided, because in case of scheduled commercial banks, the RBI gave a free hand to scheduled commercial bank to decide the lending rate, but in case of MFI, there was a regulation which was applicable, and this was the regulation. And it has been found that scheduled commercial bank, despite having lower cost of funds, are charging similar rate of interest as charged by a microfinance institution. I will repeat the statement here so it is clear to you. The scheduled commercial banks, despite having a lower cost of funds, are charging almost the similar rate of interest on the microfinancing that is provided on par with the microfinance institution. The problem is this: if you are a customer, you are a borrower in the market, you expect the lenders to compete and give you the best rate of interest. And when I say best rate of interest, you obviously expect a lower rate of interest. But despite getting access to the funds at a lower cost, banks are not giving you the loans at a lower rate. They are basically providing the rate of interest which is just smaller or just lower compared to microfinance institution. That was the problem. So RBI basically felt that this is not working out. This kind of a regulation is basically hampering the growth of these particular microfinance institutions. So RBI said, let's deregulate the rate of interest now. Is it okay? That is one very important proposal that has been put forward by RBI now. Let's deregulate. Deregulate means what? Until now, RBI basically said NBFC MFI is supposed to decide the rate of interest in this particular fashion. But now we will not do that. Let the board of the bank, let the board of this particular institution decide a policy. Based on that, let them decide the lending rate. That kind of a deregulation in the interest rates has been proposed by RBI under this particular new MFI framework. Now the next very important point is in terms of lending, in terms of presence, remember this, around 190 plus MFIs are there in case of India, around 190 plus. But around 40% plus, that is more than 85 of these are basically NBFC MFIs. That is in terms of numbers of the lenders under the microfinance lending pattern as such, the maximum number is in terms of NBFC MFIs. In addition to this, there are banks. Understand this, there are banks, small finance banks, NBFC, so on and so forth. But the highest amount of loans in terms of a value, are given by banks. Remember this statement also, because this can be used in the UPSC prelims. Although in terms of numbers, NBFC MFIs are very, very high, but in terms of a value of the loans under the microfinance sector or industry, the highest number, more than 40%, comes from the banking sector itself. Now, RBI wants to promote the competition between all of these kinds of lenders in the microfinance institution, increase the penetration, ensure that the customer is given the benefit of a right amount of a rate of interest charged on the microfinance. Now, let us go to the other proposed changes. The first one is deregulation of interest rates. Earlier, RBI basically stated that for a single borrower like this, for a single borrower under the microfinance, not more than 2 microfinance institutions should be giving loans. In simple terms, if I am a borrower, if I am taking loan from a microfinance institution, not more than 2 microfinance institutions should be giving loans to me. Imagine there are 2 microfinance institutions X and Y. If I have taken loan from both of them, then I cannot take the loan from the third microfinance institution. This was earlier regulation. This regulation has been proposed to be lifted. Remember, it is just a proposal now. Once it is notified, you will also be notified with respect to that. This is a second very important change. Third very important change. Understand this, when I say microfinance borrower, I said that we are going to target poor income households. Now, what do you mean by poor income households here? As per RBI regulations earlier, in case of rural India, any household which has an income of 1.25 lakh rupees per annum, and in case of urban as well as semi-urban, up to 2 lakh rupees per annum will be classified or will be identified to give loans under the microfinance. Is it okay? Remember this particular limit. Now, RBI has basically stated that we are not going to change this particular framework, we are going to continue with this particular same framework itself. So, again, even if the new proposal is implemented, who are going to be targeted to give these kinds of microfinance loans? These kinds of households will be again targeted. Fourth very important change, this is also very important change. Earlier, basically RBI stated that the total amount, aggregate amount of a microfinance loans which will be provided for these kinds of borrowers will be up to 75,000 rupees initially. But over a period of time, that is over a period of credit cycles like this can be increased to 1.25 lakh rupees. Is it okay? This was the limit in terms of microfinance loans that you are allowed to take earlier. Now, as per the new proposal, what RBI says is we are not going to follow this, because when we are going to follow this, the amount of a debt of a household is going to increase. For example, have a look at this. In case of a rural India, we are targeting what kind of households? Households which have an annual income of up to 1.25 lakh rupees. But if you are giving, let's say 75,000, if this particular household is taking 75,000 rupees, which is the highest limit under the microfinance, more than 50% of the annual income is in the form of a loan itself. So, the indebtedness or the amount of a debt for this particular household is going to increase. That is the precise reason what RBI has proposed is we are not going to follow this, rather we are going to introduce a new concept, that is a debt to income ratio. Remember this, debt to income ratio, that is the total amount of a loan that we are going to provide or the overall debt that the household will have, compared that with income, and this particular ratio should not be more than 50%. Is it okay? The debt to income ratio should not cross more than 50%. That is the new proposal which has been put forward by RBI with respect to regulating these particular microfinance institutions. So, what is the objective here? Objective is very simple. Like I have discussed already, we want to target these particular poor households, we want to empower the women, we want to provide more access to credit for these kinds of borrowers, women, self-help groups, rural households, etc. We want to move them out of the poverty, we want to promote financial inclusion. In order to achieve that, RBI is trying to ensure that there is a level playing field for all the microfinancial institutions. We are not going to increase the indebtedness of these particular households which are poor households, and we are going to deregulate the rate of interest which was earlier applicable on these particular NBFC MFIs. These are certain very important proposals which have been put forward by RBI, and if these are implemented, there is a very likelihood that UPSC will target these kinds of areas only. Now, based on this particular discussion that we have had so far, I have given a descriptive question here. Microfinance penetration will help in achieving multiple policy objectives of the government. In this regard, discuss how the new framework proposed by RBI will play an important role. 250 words, right? That is the scope of the question. The next important article, Alternative Investment Funds, AIF, here basically stands for Alternative Investment Fund. Now, first and foremost, what do you mean by alternative investment funds? Now, if you are an investor, you can invest in the market either in the form of equity, that is basically purchasing shares, or you can invest in the form of debt instruments also, that is you can purchase bonds, so on and so forth. So, these are generally considered to be a traditional investment. But over a period of time, what has happened is there are certain group of investors who are having huge amount of money to invest in the market, but generally they are not happy with the amount of returns that they are going to get from traditional investments. Is it okay? These are high net worth individuals or foreign investors who wish to invest take a higher risk, because obviously if you take a gamble, there is a very high expectation that you will earn higher returns. So they are not happy with these kinds of traditional investments because they are getting moderate returns or lower returns. They want to take a higher risk, they want to invest a higher amount, they want to earn higher returns. For those kinds of investors, there is a new model of investment, that is alternative investment funds, AIFs. Now understand this, in addition to this, there is another reason also. For example, if you want to invest in a hedge fund, you want to invest in a venture capital fund, and different types of instruments in the market or asset classes in the market, generally SEBI does not allow you. For example, if you want to invest in an unlisted startup, you want to invest in a company which is not listed but growing at a very fast pace, generally there are certain regulations. But a new class of asset investment type has been introduced, AIF, by SEBI in 2012. Now, why this particular article becomes important for your UPSC exams? Please connect the dots here. Alternative investment funds in case of Indian economy in the last 5 years have actually boomed. The amount of investment through AIFs has kept on increasing. If there is a trend type of a question, please remember this. You can see this particular graph here, the total amount of investment, there are 3 categories, I'll go to that. The total amount of investment under AIF in the last 5 years has actually increased in the Indian market. Now, in the year 2020 as well as 2021 also, it has been seen that the total amount of investment through AIF has actually increased. Now, this is important for a simple reason. 2020 and 2021 are not normal years. By any stretch of imagination, these are not normal years. Generally, we have seen such a high amount of volatility in the overall market in terms of, let's say, GDP growth rate, capital formation, consumer confidence, so on and so forth, even take inflation for that matter. There has been a huge amount of volatility in the market. But what has been certain during this particular period of time is, both in the year 2020 as well as 21, the amount of investment that has flown into the market through AIFs, alternative investment funds, has increased, and that is a very important point you need to remember. Now, beyond this, what is the idea for AIF? Let's take the basic points first here. The AIF are basically nothing but private investments. Is it okay? Private investments which are pooled, and these are used to invest in the market as per the policy. For example, imagine all of your millionaires, just imagine this, all of your millionaires, all of your huge amount of money to invest, right? And just to put a cherry on the cake, imagine your millionaires in terms of a dollar currency, not rupees, dollars. So you have huge amount to invest. But in the recent times, what has happened in the global market is the interest rates have kept on declining. All of you know this. The interest rates have declined, and there is a very simple reason for that. In most of the economies, there is a volatility. In order to revive the economic growth, the central bankers are basically going for a quantitative easing monetary policy, and the interest rates are actually on a lower side. But you as an investor, you want to invest in the market, take a risk but earn huge amount of a return. So what you will do, you will take your money and come to India and make an investment for a simple reason. Understand this, India has a huge amount of a growth potential. That is one attractive point for you. Second, in case of India, it is having one of the highest startup ecosystem in the world, and startups generally require huge amount of funds. And in case of India, this particular economy, since it is having high potential to move from a developing economy to, let's say, a developed country, or to become a $5 trillion economy by 2024-25, the idea is the requirement of investment, demand for money will be very, very high. So citing all of these particular factors, you can just understand why this amount of investment is actually flowing into India. Now, although I am using the example that you are a foreign investor, it does not mean that only foreign investors will invest in AIF. Please remember this. AIF can pool in the investment from the foreign investors also, from the domestic market also. Now, let us go beyond this. These particular AIFs are basically categorized into 3. Category 1, Category 2 and Category 3. Now, as per SEBI guidelines, understand this, as per SEBI guidelines, in case of a Category 1, generally we expect huge amount of a spillover effect on the economy. Any amount of investment that will come through Category 1, we expect a spillover effect, right? What do you mean by spillover effect? For example, investment in startups, investment in, let's say, infrastructure development. You generally see there is a spillover effect, which essentially means employment generation, capital formation happening, so on and so forth. That is a precise reason in category 1, basically government will try to promote these kinds of investments by giving, let's say, tax breaks, right? For example, the infrastructure funds, venture capital funds, the SME, small and medium enterprises, or even angel funds are kept under the category 1. In case of a category, I will go to category 3, I will skip category 2. That is, there is a particular reason for that, give me a minute. In case of category 3, generally SEBI says these kinds of investors are expecting a short term returns. They want to invest and within short term they want to get returns. For example, hedge funds. And because these are mainly focused on returns and these do not have any kind of a spillover effect, Government of India does not provide any kind of a incentive for these kinds of investment. Now, those kinds of AIFs or the investment pools which will not fall under category 1 as well as category 3 will basically be kept under category 2. Now, you will understand why I skipped 2. Those which will not fall under 1 as well as 3 will be kept under category 2. For example, private equity funds, debt funds, etc. are kept under the category 2. And again, even in case of category 2, government does not provide any kind of incentive. Now, out of the total investment within the AIF which has flown into India, majority of the investment has actually come from the category 2 itself. That is 66% of the total investments that have flown or that have been invested in the Indian market are from the category 2. Category 1 accounts for 10% and category 3 accounts for 24% of the total AIF funds here. Now, how much is the total investment under AIF? The article in the first paragraph itself will tell you this particular information. The total amount of the alternative investment funds, that is the investment under AIF, has very recently crossed more than 2 lakh crore mark, right? In the fourth quarter of the last financial year, it has crossed more than 2 lakh crore mark. And this is important for a simple reason. In the last financial year, that is the financial year 20 which ended, it was 1.5 lakh crore rupees. So, in one financial year, it has increased by more than 30%, which essentially means a lot of funds have been invested in the market through the concept of AIF itself. So, these are certain points with respect to the alternative investment funds which have seen a surge in case of Indian economy in the last 1 year. Now, beyond this, what is given in the article, there are two very important points you need to remember with respect to AIFs. One is with respect to concept of pass-through status. Remember this, pass-through status. Now, pass-through status essentially means whenever income is generated from AIF, understand this very carefully, whenever income is generated through AIF, the tax on that will not be collected at the point of generation, rather the tax will be collected when the income will be transferred to the investors. I will give you an example to make it clear. Imagine all of you have given money to me. Is it okay? I am running an AIF, alternative investment fund. All of you have given money to me. So, when the profits are generated, should the tax be collected here, that is at AIF, or I will transfer the part of profits to all of you because you are investors and the tax will be collected from your hands. If the tax is collected through a latter route, that is the second route, I will transfer the profits to you because you have invested and the government will impose tax in the hands of the investors. That mechanism is called as a pass-through status. Now, what is the advantage here? Understand this very carefully. Earlier, I basically stated that in case of AIFs, domestic investors have also invested, foreign investors also have invested. Now, imagine you are a foreign investor where the income tax rate is 10%. I am just throwing an arbitrary number here, where the income tax rate is 10%. And in case of India, let us put an arbitrary number here, income tax rate is 30%. So, would you want to be imposed an income tax at a rate of 10% or 30%? If you are a foreign investor and if government of India says, I will impose income tax of 30% at the point of profit generation, that is at AIF itself, you will be losing a lot of income tax here, or you will be paying a lot of income tax. In essence, you will be earning lower profit. But rather than that, what if I say, as a government, what if I say, You generate profit, you invest in the AIF, you take the profit, and whatever is the income tax rate in your country, you pay the income tax there. So obviously you will enjoy huge amount of profits because you are paying a lower income tax. This is one way why pass-through status is very, very important. Now understand this very carefully. For category 1 and category 2, government has announced pass-through status. In the budget of 2015, Finance Minister Mr. Arun Jaitley basically announced that pass-through status will be given for the category 1 as well as category 2 investments. But for category 3, even today pass-through status is not given. For category 3, pass-through status is not yet given. And 2016 SEBI set up one committee which was headed by Mr. Narayan Murthy panel. And this particular Narayan Murthy panel basically recommended that even for category 3, pass-through status must be provided. And what is the advantage here? You have hedge funds, you have PIB funds, that is private investment in public equity. You have lot of these kinds of investment tools under the category 3. And if you provide pass-through status, the foreign investors will be attracted to invest in these kinds of funds in India. That is the advantage of providing a pass-through status even for category 3. This is one more point. And the second important point in addition to what we have discussed is, here is an AIF. Let's assume XYZ is an alternative investment fund. It is controlled and owned by a resident of India. That is basically management is with Indian only. Even if the foreign investment is within this particular AIF, follow this very carefully. Here is an XYZ alternative investment fund which is managed and controlled by an Indian. Even if there is a foreign investment within this particular AIF, the FDI restrictions will not be applicable on this particular foreign investment. Now, what do you mean by FDI restrictions? Whenever FDI has to come into India, there are sectoral restrictions. For example, in this particular sector, you are allowed to invest only 50% or up to 49%. In this sector, up to 74%, 76%. In this sector, up to 26%. These kind of sectoral restrictions are not applicable on this kinds of foreign investment which is coming into the AIF which is controlled by an Indian. Is it okay? And even with respect to FEMA rules, whenever foreign investment or foreign currency has come into India, there are certain guidelines or provisions which will become applicable on this particular investment because of FEMA. Right. So, even under FEMA, these particular provisions will not be applicable for these foreign investments which are coming into this particular AIF. So, these are certain very important points you need to understand with respect to alternative investment funds. Now, based on this particular discussion, I have given a question here. Consider the following statements regarding alternative investment funds. All the foreign investments into AIFs is subject to FDI sectoral caps. Wrong. This is a wrong statement. Because I have said if there is an AIF which is managed and controlled by an Indian, and if there is a foreign investment coming into this particular AIF, the FDI sectoral caps are not applicable on this. Second, pass-through status is available for all the three categories of AIFs. Again the statement is wrong. Category 1, category 2 it is applicable, category 3 no, it is not applicable. So, the right option will be option D, neither 1 nor 2. Third, cooperative banks. Now, understand the logic here. Government of India has basically introduced the concept of Banking Regulation Amendment 2020, and the provisions of a Banking Regulation Amendment 2020 have come into force from 1st April 2021. And this particular Banking Regulation Amendment Act basically focuses on cooperative credit societies or cooperative banking structure. Now, within cooperative banking structure also understand where the provisions are applicable. We have cooperative credit institution as a headline here, below which there are urban cooperative banks, is it okay? Cooperative credit institutions, urban and rural. Within urban you have a scheduled, non-scheduled urban cooperative bank, and within that again single state as well as a multi-state urban cooperative banks. With respect to rural, again there are two classification, short term as well as a long term. Focus on short term here because the provisions are applicable for these kinds of short term cooperative banks which is being discussed here. Within the short term, please understand this very carefully, there is a 3-tier structure. Generally we say 3-tier structure, but in some of the states, around 10 states as well as 4 union territories, there is a 2-tier structure. That is the short term credit institutions or cooperative credit institutions. You will have state cooperative banks, you will have district cooperative banks, and you will also have at the lowest level primary agriculture cooperative societies, PACS. Now understand this very carefully. In terms of the delayering process, what do you mean by delayering process? This is a 3-tier structure, a 3-tier or a 3-layer structure within the short term cooperative banking institutions in India. Many of the states want to delayer this particular structure. Delayer means reduce the number of layers. Why? In the last couple of years, there has been a lot of discussion with respect to cooperative banking structures in India, and the performance of cooperative banks because of a deregulation has been in discussion. Please have a look at the earlier discussions that we have had with respect to cooperative banks. So some of the states basically looked at this particular banking regulation, the act which has been notified from the 1st April, approached RBI and said, we want to delayer in a sense, we want to reduce the number of layers of the short term credit institutions or short term cooperative banking structure. We want to merge the state cooperative banks as well as a district cooperative banking structure like this have only one layer. And as such, I have already mentioned 10 states and 4 union territories already have a 2 layers or 2-tier structure rather than having 3-tier structure like this. So what RBI basically felt that rather than basically accepting proposals from individual states, let me bring in a framework, let me bring in a guideline as such, which will basically ensure what has to be done with respect to concept of delayering here. So RBI has come out with a set of guidelines on what parameters this particular delayering process will be conducted. Now why RBI is important here? Please understand this. Under the Banking Regulation Act, which has come into force now, this kind of a delayering process or amalgamation of a cooperative bank, short term cooperative banks like this, has to be approved by RBI. Is it okay? This kind of a amalgamation has to be approved by RBI. So RBI basically said, please wait, I will come out with certain guidelines, and after that we will look at this particular concept of delayering. So as per RBI guidelines, what it has stated? First, the proposal to amalgamate or delayer this particular short term cooperative banks, that is STCBs as well as DCCBs, the proposal has to come from the state government itself. I am not going to put in a proposal, the state government has to come out with a proposal, first point. But not just proposal, it says that you will have to check with the legal framework first. Check with the legal framework, is it possible, it is feasible or not, and only then come out with a proposal. Third point, in case you want to go for amalgamation like this and in future there is a requirement of a liquidity, because you have put in the proposal to amalgamate both of them, you will have to provide liquidity for these particular banks. Because when you are going to propose the amalgamation like this, first and foremost you will have to see that whether the amalgamation or the new entity, which is a merger of both of them, whether it is economically feasible or not. It is not just that you will amalgamate and the new entity will close. We do not want that to happen. So first you will have to see whether the amalgamation is feasible, and in the future if there is a requirement of liquidity, then you will have to basically provide this particular liquidity for the new entity. So these are some of the guidelines which have been announced by RBI. Now what is being discussed in the article? The article basically says that the state government of Maharashtra is opposed to this particular guideline. Why? Is a political reason, right? In a nutshell, please understand. Generally in case of these kinds of banks, there are elections happening, there are appointments to MD, so on and so forth, and most of the times these the cooperative banks at a lower rung in the society or at the villages, these are influenced by the politicians. In simple terms, the elections, appointments are generally done of these particular people who are belonging to political parties. So Maharashtra state government is expected to reject RBI guidelines, but that is a political reason. But beyond this, there is also concern from some of the stakeholders that if you are going to merge these particular STCBs as well as DCCBs like this, this is very important because DCCB basically functions as a linkage or an intermediate between a state cooperative bank as well as a primary agriculture cooperative societies. Now if you are going to merge like this, don't you think the whole 3-tier structure which is hinging upon this particular all the 3 tiers like this, the disturbance will be caused in the 3 tier structure. And this may basically impact the kind of borrowers of the agriculture sector who are dependent on these kinds of loans in the rural market. So, these are certain important points that are being discussed in terms of this particular article. The next article is with respect to special economic zones. Central government is basically seeking to provide a duty relief for the SEZ units. Now, what is this? First and foremost, SEZ stands for special economic zones. What do you mean by special economic zone? Government has identified certain region. It is part of India only. It is an enclave. I am using a technical term now. It is part of Indian territory, enclave, but for taxation purposes, we will treat as if it is not part of India. That is, in simple terms, imagine this is India. Again, imagine, I know this does not look like India, but no point in drawing the map now. So, imagine this is India and here is a region which government of India has identified as a special economic zone. Is it okay? So, object is very simple. It is a part of Indian territory itself, no doubt, but in terms of regulations, in terms of taxation purposes, we will treat as if this is not part of India. The logic is very simple. Government of India wants to promote manufacturing sector, wants to promote services sector, food processing, so on and so forth, through these particular these particular enclaves itself, that is special economic zones. And if you start treating them as part of India in terms of taxation, what will happen is, imagine there is an import of a raw material which they are using to manufacture a product, and again they are exporting. Then if government of India treats this as part of India in terms of taxation, on imports it will impose tax, customs has to be paid, and if they are going to pay customs, obviously the cost of manufacturing will increase and your exports will become lesser competitive in the international market. So, for that particular reason, generally what happens is, these SEZs or the units which are present in the SEZs, whenever they import some certain amount of raw material, anything like this, the taxation will not be imposed on this, because we want them to predominantly export these particular products in the international market. This is a basic idea. Now, what is the connection with the current affairs here? The connection is, because of the pandemic, the demand for these exports which are exported by the SEZs has come down. Is it okay? The exports of these particular SEZs have been affected very badly because of pandemic. Now, the problem here is, if these particular SEZs are unable to export whatever they have produced, they will not be able to sell them even in the domestic market. Why? Understand the logic here. When we discuss the basic idea of a SEZ, I said it is an enclave only, but in terms of taxation, we will simply treat it as like a foreign territory, or we will not impose taxes. The basic idea is, when an unit present in the SEZ manufactures, sells it within the domestic tariff area, I will use a technical term here, DTA, domestic tariff area, government says, when you import it, I did not impose any taxes, I did not impose any customs on your imports, but you have used it to manufacture and sell it in the domestic market, then I will simply treat it as if it is an import now, and I will impose customs on this. You will have to pay customs or tariff on this particular product. So, idea is, we want you to export, we do not want to give you an advantage, that is no customs, import at a cheaper cost, manufacture and sell it in the domestic market. No, we want you to export it. But what has happened? Exports are affected, they are unable to export whatever they are producing in the international market. So, government of India is basically seeking to provide a duty relief for these particular SEZ units. The objective is, if I can provide this particular relief whenever they are going to sell it in the domestic tariff area itself, whatever they are producing, they will be able to sell it in the market and they will be able to overcome this particular distress which has been caused because of the pandemic. That is in just what is provided in this particular article. Let me go to the next article, Green Tariff Plan. Now, to understand the idea of a green tariff plan, understand certain basic points here. Here is a DISCOM. What do you mean by DISCOM? Distribution company. This particular DISCOM will purchase electricity from thermal producer, will purchase electricity from the solar producer, will also purchase electricity from let us say wind energy producer. So, he is going to purchase electricity from all of them and pool the electricity and sell it to the consumer. Is the logic okay? Purchase and sell. But the problem here is when the DISCOM purchases electricity from all the three here, I am just taking three buyers here or three sellers and one buyer. The cost of thermal electricity in case of India, thermal energy is comparatively higher. As of the latest information, for solar per unit cost is less than 2 rupee, and for wind energy it is just somewhere around 2.3 rupee per unit. But for thermal, NTPC generally sells it at a price above 3 rupees per unit. So have a look at this. The DISCOM has purchased electricity from all the three. From 2 it has purchased at a lower cost, from 1 it has purchased at a higher cost. But when they will sell this particular electricity to the consumers, they will charge the average price. Is it okay? They will charge the average price. They will not charge, right? They will not identify that this is solar energy, so you purchase and pay me lesser. No, that kind of a distinction is not done by the DISCOM. They will simply purchase, pool the electricity and sell it to consumers at an average price. Now, what is this particular concept of a green tariff proposal? Now, under this particular green tariff plan, have a look at this. Imagine this particular consumer is an industrial consumer. Is it okay? Imagine this particular consumer is an industrial consumer. He wants to purchase renewable energy only. Is it okay? He wants to purchase or get access to renewable energy only. Right now, there is a methodology. There is a concept called as open access. Give me a minute, I will come to this. Even now, there is a process, but there are problems with that. But the logic here is this particular industrial consumer might simply ask the DISCOM to sell him only renewable energy. And the logic for this particular industrial consumer will be, one, if I purchase only renewable energy, it simply means I am promoting renewable energy sector in India, so my image will be built in the market. And second, as such, if you see, thermal energy costs more than renewable energy in India. So I will be able to target and purchase only renewable energy so that the cost will come down for me. This concept is called as a green tariff plan. Is that okay? In essence, the industrial consumers, as of now, proposal has not been put forward, only the idea has been put forward. The proposal is yet to be announced by the government, that is, the mechanism is yet to be announced by the government. Government of India is basically saying that these particular industrial consumers can directly get access to only renewable energy and pay for the average cost of the renewable energy, that is weighted average cost of renewable energy. Now, this concept is called as a green tariff plan. It is not a very novel concept as such. Karnataka government introduced this back in the year 2012 itself. Maharashtra government very recently has announced this concept of a green tariff plan. Now, this is being picked up by the central government. So, the advantage here is with this particular proposal, renewable energy sector will be promoted, right? The industrial consumers can directly target to purchase only the renewable energy, right? So, these are some of the advantages that are associated with the idea of a green tariff plan. And not to forget, this will help in government of India moving towards 175 gigawatt target of renewable energy capacity. Now, I said that with respect to these industrial consumers who want to purchase the electricity, there is a concept of a open access. Understand this concept very carefully. The concept of open access, I will use the short form here, OA. The concept of open access was proposed by the government under the Electricity Act of 2003, very famous. Electricity Act of 2003 is very famous. So, government of India put forward this idea of open access under the EA 2003. Under the open access, if you are a large consumer in terms of electricity, that is you are consuming electricity to the tune of 1 megawatt, then you can directly purchase this particular electricity from the open market. Is it okay? The logic is very simple. DISCOMs are purchasing electricity from someone and then supplying to you. That is a grid supply. And when there is an intermediary such as a DISCOM, obviously the cost or the prices will be higher. But rather than that, what if you can directly purchase this particular electricity from a producer in the open market itself? That is the concept of a open access, which was proposed, but it has not been very famous in India. It has not picked up, has not been very successful on the lines which was expected by the government. Because please understand this, whenever you want to purchase electricity from the open market like this, you will have to use the grid to supply electricity. Is it okay? For example, if I am the DISCOM, I have developed infrastructure, I have provided wiring, for example, to your industrial unit. you purchase electricity from someone else. So how does he supply the electricity to you? He has to use the grid network only. So DISCOMs generally discourage this kind of a practice of usage of their grid. And beyond this, there are many other reasons, but essentially the point is, although it has been proposed a long time ago, the open access policy has not been very successful. Now Government of India is trying to put forward this particular concept of a green tariff plan, wherein again the same idea of promoting renewable energy, so on and so forth, is being promoted. So this is a discussion with respect to this particular article. Based on this, I have given a question here. Consider the following statements regarding green tariff plan. This may reduce the prices at which the electricity is sold to the industrial consumers. Underline the term may. Yes, the statement is correct. Now the problem here is, I will give you another statement. Have a look at this. Both are two different statements, do not get confused here. I have replaced the term may with will. Read the statement now. This will reduce the prices at which the electricity is sold to the industrial consumers. Then the statement will be wrong. Is it okay? Will? No, there is no guarantee because there is a concern, I will tell you that. This may? Definitely yes. Now what is the logic here? Right? Why changing one term or one word itself will change the answer? The reason is, have a look at this. I said that in case of a thermal energy, the prices per unit are about 3 rupees, whereas in case of a renewable such as wind and such as solar, the prices have declined and it is in the range of less than 2 rupees to around 2.3 rupees per unit. But it has not always been like this. That is, a couple of years ago, the prices of solar as well as wind were much higher or were higher compared to thermal energy. Now the logic is, here is a DISCOM. Have a look at this. Here is a DISCOM. What if this particular DISCOM had entered into an agreement with wind energy producer to supply electricity many years ago, and when the agreement was done, per unit cost of this wind energy would have been higher? Is the logic okay? Today the wind energy per unit is around 2.2 to 2.3 rupees, but many years ago it was much higher. So what if when the agreement was done between the DISCOM and the wind energy producer, the cost was 4 rupee per unit, or for that matter even 3.5 rupees per unit? So obviously this wind energy producer will keep on supplying at 3 rupee 50 paisa only. So even today he will supply at 3 rupee 50 paisa. So although the market price would have fallen, but still because there is a contract, he is supplying at 3 rupee 50 paisa. So at that particular point of time, right, the DISCOM would be purchasing the thermal energy at 3 rupee per unit and the wind energy at 3.5 rupees per unit. So even if there is a green tariff plan introduced for this particular area, the DISCOM will have to transfer higher prices to the consumer. That is the reason this may reduce the prices at which the electricity is sold to industrial consumers. Yes, the statement is correct. This will reduce may not be correct. Right? Various experts have already raised a concern because different DISCOMs have entered into agreement with the different renewable energy producers at different points of time. And this basically might lead to difference in the pricing for the same quantity of electricity supplied in different states. So first statement correct. Such a policy is already present in some of the states. Statement is true, right? Like I said, in Karnataka it is present, in Maharashtra recently it has been announced. So both the statements are true. Right option will be option C, both 1 and 2. Next article related to draft port bill. Now before I enter into discussions provided related to points on this particular article, please remember this is just a proposal as of now, and there is a discussion which has been happening between the ministries only. This has not yet been put forward in the public domain, it is in the consultation stage. But nevertheless, right, even though it is at the consultation stage itself, many of the states have already raised a concern with respect to draft port bill. Now what is the idea here? Please understand, in case of India, the ports are divided into two parts. Is it okay? Ports are divided into two parts, major ports and non-major ports. I am using the term non-major ports, they will replace that with the idea of a minor port. Now what is the basic difference? Based on the capacity handling, these were divided into major and minor, a very old legacy as such. Now in case of India, there are 12 major ports, but the most important point will be these major ports are under the administration or basically will come under the regulation of a central government, that is Ministry of Ports, Shipping and Waterways. whereas these minor ports basically in terms of construction, planning, development, controlling, all of this related to minor ports will come under the state government. And this has been clearly laid down under the Indian Ports Act. Now, what has been proposed is this: the central government wants to basically repeal, right, basically take out these particular provisions of the Indian Ports Act of 1908. As per this particular act, the minor ports will be planned, developed, controlled and regulated by whom? State government. Now, central government wants to change this particular provision and simply state that henceforth, even in case of minor ports, the government of India will have more authority. Rather than state governments having authority, the government of India through various mechanisms will have more authority. For example, there is a Maritime State Development Council, MSDC, Maritime State Development Council. This MSDC was set up in the year 1997. Remember all of these particular points. This was set up in 1997. It is chaired by the Minister of Shipping, Ports and Waterways. Now, as per this particular MSDC, this particular concept of MSDC or the authority of MSDC is just right, an authority which will give inputs, which is an advisory body. It does not have too much of powers, it is just giving recommendations or advices in terms of development of minor ports. But what Government of India has proposed under this particular ports bill or amendment is basically to give statutory status to MSDC. Is it okay? Give statutory status to MSDC, and henceforth the development, control, regulation of minor ports would be done by MSDC. So, the state governments are crying foul over this particular proposal. They are simply saying that as per Indian Ports Act of 1908, we are given the powers. We have been given the powers to monitor, develop, plan these particular minor ports. But what the central government is trying to do with respect to this particular draft port bill is trying to snatch away this particular power which has been given to us. It is against federalism. And citing this only, the Chief Minister of Tamil Nadu has given or has written letter to 9 other states. These are basically the states which have a coastline as such. And he has basically urged these particular states to raise concern or oppose this particular draft port bill. Now, beyond this, remember one more statement here with respect to MSDC. It is just an advisory body. We have taken care of this. And most importantly, as per MSDC, the points as such, it is supposed to meet once every 6 months, at least once every 6 months, right? That is the importance of MSDC. So, these are certain points with respect to draft port bill which are provided in the article. But let us go beyond this. What is the advantage? What is the concern here? Concern as such I have already said, it is against the federalist nature of India. States are crying foul over the idea of a federalism. Second, the state governments, first I will deal with the opposing points, then I will go to our concern points, then I will go to the benefits or why it should be introduced. So, one, against federalism. Second, many of the state governments have already invested huge amount of money and they have developed these particular minor ports. Is it okay? They have developed these particular minor ports and they are attracting lot of investment through PPP model to develop other minor ports also. Now, Government of India wants to take away all of these particular ports from the management of the state governments. They do not want this kinds of the power grab by the central government, and they are saying this will affect the PPP, public private investments that we have proposed for many of these particular minor ports. One state, that is the state of Odisha, also has opposed the provisions of this particular draft bill. Their argument is different. They are simply saying we have already passed a state management or a state maritime board bill as such, and this particular bill is lying with the president. That is, to be more precise, it is lying with one of the ministries of the central government. Now, if you basically pass this particular bill, introduce the provisions, make it an act and introduce the provision, after that you might give consent to the bill that we have passed. And once the provisions of the new port bill are implemented, the bill that we have passed earlier will not be recognized, because there are no provisions to recognize such the maritime boards of the state governments. So, Odisha state government also has raised concern with respect to this particular draft port bill. Now, why this should be done? Why it should be introduced? Now, please understand, in many of the states it has been found that lot of investments have been done to develop these particular minor ports. But understand this, In many of the states, it has been found that these particular ports are very nearby. There is a major port and nearby itself there are many minor ports. For example, take the state of Odisha itself. It has got a coastline of around 480 kilometers. There are 3 operational the minor ports along with other major ports within the Odisha. In addition to this, government in Odisha has proposed to develop 12 other ports. So in essence, 15 ports will be developed in a state with a coastline of 480 plus kilometers, which essentially means for every 30 plus kilometers there is a minor port like this. But the concern is not just attracting investment, how effectively the investments will be utilized. The argument is of the existing ports which are already present in the Odisha, 2 of the ports are suffering because of idle capacity, means they have got lot of capacity but they are not receiving the right amount of traffic. So argument here is this idea of a development of ports should be centralized. Central government should be taking over where to invest, how much to invest, how many ports to develop, etc., so that these kinds of investments which will lead to idle capacity will be addressed. And moreover, the idea of a minor and major ports or major and non-major ports is a colonial identification or colonial classifications. Today, various minor ports are handling more traffic compared to major port itself. For example, Adani's Mundra port, very famous. Adani's Mundra port handles a very high amount of traffic, even much higher than many of these particular major ports. So these are some of the reasons which have been cited by many of the experts, which basically support the idea of the draft port bill, which is being again we've been in the consultation stage as of now. Next article, Defaulters and Enforcement Directorate. Again, you don't have to read the full article. Why it is important for UPSC? If you know that, more than sufficient. In case of UPSC exam, if at all a question is asked in the mains exam with respect to, let's say, addressing NPA issue in India, you can use this particular article, only a few points which will provide good fodder for you to write mains exam. Now there are 3 economic offenders or 3 economic fugitives. The Enforcement Directorate has basically targeted the assets of these particular 3 businessmen and has basically confiscated the assets of these particular 3 businessmen and transferred the assets to the public sector banks. As per the article which has been provided, data which has been provided in the article, these particular banks, public sector banks, have suffered a loss over 22,000 crores, and the assets which are confiscated by the Enforcement Directorate and the value of these particular assets comes somewhere over 18,000 crore rupees. Exact number you don't have to mug up. But the basic idea is this will provide certain relief to these particular public sector banks because they have incurred a huge amount of a loss to the tune of more than 22,000 crores. Now understand this, what are the positive points out of this particular story? What should you take out of this particular story? One, the Enforcement Directorate, Government of India as well as public sector banks are basically taking measures, taking various steps to recover their NPS. This is the first point. Second, the NPS which have been generated by the large businessmen like this who have become economic offenders or fugitives like this, they are being targeted, which sends a very good signal to other maybe probable defaulters in the future. It essentially means doesn't matter whether you go to this country or this country after taking a loan and defaulting in India, the agencies in India will come behind you and try to recover the loan from you. And in addition to this, they will also try to confiscate or they will try to prosecute you under various laws, for example, PMLA, Prevention of Money Laundering Act. Now, these are some of the positive points that you need to take out of this particular story. Having said so, there are certain concerns raised by various experts with respect to even this news. One, yes, they have confiscated the assets, but what is the true value of the asset? What is the true value of the asset? Now, what do you mean by what is the true value of the asset? They have confiscated cash, along with that they have confiscated other immobile assets also. The argument here is, what if you have confiscated one of the properties of these particular economic offenders? You might say the value of the asset is this much, but by the time the bank actually sells the asset in the market and recovers the money, the value could be something else, right? For example, there are many stakeholders in the system, there are many interested parties. When you confiscate the asset, they will also go to court and file a case against this particular asset and they will try to delay the process. and in this particular process the banks will not be able to recover the right value of the asset. That is the first point. Second point, even if you have the property, what is the guarantee that the buyers in the market will be purchasing the property at the same price that you expect them to? And there are so many issues with respect to the true value of the asset here. Second, yes, the banks might recover 18,000 crore worth of the money that they have incurred in the form of a loss, but this is not going to dent the total value of NPAs that are present in the banking sector. For example, in the article they say that the total value of NPAs in the banking sector are over 8 lakh crore rupees, and because of the pandemic this particular NPA is expected to increase. So the amount of recovery that is done is, let's say, on paper 18,000 crore rupees, but the total value of NPA is going to expand beyond 8 lakh crore rupees. So what kind of impact that will cause in terms of reduction of the NPAs? Right. So these are some of the concerns which have been raised with respect to this particular article, and beyond this, right, the rest of the things that are given is just a story. You don't have to mug up the story, nor are you required to write the story in the exam. Next important article, One Nation, One Ration Card, very important, and NFSA, National Food Security Act. Now in the earlier videos, yes, I know we have discussed both of the concepts, but very recently Supreme Court of India has issued certain orders to the central government as well as state government with respect to One Nation, One Ration Card as well as the National Food Security Act. We will focus only on those particular points here. First and foremost, National Food Security Act, please understand this. The central government has implemented National Food Security Act, and under this it has basically given the duty of identifying the beneficiaries to the state government. But how many beneficiaries will be allocated to each of the states is decided by the central government based on the census of 2011. Is that okay? Based on the census of 2011, certain quotas have been allocated to these particular states. Now what is the concern here? Concern is you want to provide food security to beneficiaries under NFSA, but the base for identification that you have taken is the census of 2011, and we are in the year 2021. The population as per census of 2011 was 1.21 billion or 121 odd crore, and today as per the documents which have been published or which have been submitted to Supreme Court, the total population in case of India is more than 139 crores. So obviously whatever your coverage you are providing doesn't reflect the correct population, doesn't reflect the true population which is present in India. So Supreme Court of India has basically stated, why don't you look at what is the coverage? Why don't you have a relook at your coverage? Because the quota that you have provided is based on the census of 2011. That is the first point. And within this particular quota itself, there is a second concern. What is the second concern? Most of the states have already exhausted their quota of entitlement under NFSA. That is, most of the states have basically given or identified the number of beneficiaries, and this number is already much higher than what is the number allocated by the central government under NFSA. And many of the states are left out with just around 5% of the quota numbers as such, which essentially means there is a need to expand the coverage under NFSA. That is the second point. Third point, that is ONORC, One Nation, One Ration Card. Very important, understand this very carefully. One Nation, One Ration Card will provide a portability in terms of getting access to benefits. Under NFSA, whatever entitlement you are provided, it will provide portability with respect to that. What is the meaning of this? Imagine you are a migrant worker, you have moved from one place to another place, you are registered in the first state, but you want entitlement in the second state. So that kind of portability will be provided with One Nation, One Ration Card. Now how it is implemented, that is where I expect the question will fall in the UPSC. In terms of implementing One Nation, One Ration Card, two very important systems are being used by the government. One is IMPDS, Integrated Management of Public Distribution System, and the second one is Anna Vitaran. Remember both of them. One is IMPDS and the second one is Anna Vitaran. What is the basic difference here is, in case of Anna Vitaran, it will have all the details of the intra-state transaction. inter-district transaction as well as intra-district transaction. Whereas interstate transactions are basically recorded under IMPDS. You will have to remember both of them very, very carefully. Generally, when any beneficiary approaches, when any beneficiary goes to, let's say, PDS or FPS, a fair price shop, he will provide his Aadhaar credentials or he will provide his biometric authentication. Then his data is matched against the data within the Annavitran portal, and then the entitlement is provided. And the beauty of a one nation, one ration card is, imagine here is a household, there are 3 people who are identified as beneficiaries. One of the beneficiaries has moved out of the state, he can still receive his entitlement in the second state, and the remaining 2 members will continue to get the entitlement in the first state or their initial state itself. That kind of benefit is being provided by ONORC. Now, what is the issue here? The Supreme Court of India has basically identified that some of the states are yet to implement this particular one nation, one ration card, and has basically asked the central government to ensure that all the states implement one nation, one ration card by July 31st. That is another important point. Third important point is with respect to National Database for Unorganized Workers, NDUW, National Database for Unorganized Workers. Basically, this particular concept was put forward and the Supreme Court of India asked the central government to create a database for all the unorganized workers, especially migrant workers, in the 2018 itself. So far, Supreme Court of India has observed that so far, even after so many years, central government has not been able to develop this particular database. And central government has basically stated it is not because that we are not doing anything, it is because of the software issues. And again, the Supreme Court of India has stated that within this particular time period, please complete this particular database of National Database of Unorganized Workers. So, these are certain very, very important points with respect to these particular articles. Now, let us go to the next article, NPS. Now, in the earlier videos, we have already discussed the idea of a NPS, which are or the issue with respect to NPS, what is annuitization, so on and so forth. I will not be looking into all of them. What I will be focusing is what is the update here, just the update. Beyond that, please look at the earlier videos, you will understand what is the issue of NPS. Now, 3 important points here. One, with respect to annuitization, earlier the limit was 2.5 lakh rupees. Earlier the limit was, just make a correction, 2 lakh rupees. That is, if the amount of corpus, if the amount of money that you have under NPS was beyond 2 lakh rupees, then you are supposed to go for annuitization, compulsory annuitization. And if it is up to 2 lakh rupees, you could simply withdraw this. Now, this particular limit has been increased from 2 lakh rupees to 5 lakh rupees. This is the first very important update, please remember this. Second important update, the entry age has been increased. The entry age within the NPS has been increased. The entry age has been increased from 65 years to 70 years, remember this. And the third point, exit age also has been increased. It has been increased from 70 years to 75 years. So, these are the 3 very important updates that have been announced by National Pension Scheme, and these are the only 3 points that you need to remember with respect to this particular article. Now, with respect to annuitization, what is NPS, when it was introduced, so on and so forth, all the basic points have been discussed in the earlier videos itself. Please go through all of that. Next, gold hallmarking rules. Again, not strictly the idea of the economics as such, but suddenly UPSC might pick up the issue of a gold hallmarking and ask a question either in the prelims or in the mains. Now, first and foremost, what do you mean by hallmarking? Now, whenever you have purchased gold jewelry in the market, either from company X, Y, Z, doesn't matter, generally these particular gold jewelry will have certain notations, certain symbols will be there, right. This particular idea of providing symbols or notations on the gold is called as a hallmarking. Hallmarking essentially means one, providing what is the purity of the gold. What is the purity? 24 karat, 23 karat, 916, what is the purity? Right. One, it will provide the purity of the gold. Second, what is the year of a hallmarking, that will also be provided. Which company is providing the hallmarking and assaying, that will also be provided. Fourth point will be BIS, a symbol will be there. Bureau of Indian Standards, generally you will see a triangle symbol like this, right. Again, it may not look like a triangle, but if you just see the jewelry you will realize, or even if you go to the BIS website you will realize. So idea is these four, in addition to this, which is the company from whom or who is the seller of this particular gold, even their symbol will be printed. So all these particular 5 parameters put together is basic idea for hallmarking. Now please understand, even today if the gold is up to 2 grams, if it is up to 2 grams you do not have to go for a hallmarking. If the seller has annual sales of up to 40 lakh rupees, there is no requirement of a hallmarking of the gold that is going to sell to you. Now why this is there in the newspaper? 2 reasons. One, in all the cities where assaying and hallmarking centers are present, remember this, AHCs, okay, AHCs, in all the cities where AHCs are present, now the government says the gold seller will have to go for compulsory hallmarking. Is it okay? I will repeat the statement here. In all the cities where AHCs are present, the gold which is sold, compulsorily the seller has to go for gold hallmarking. First point. Second, because of the pandemic, many of these particular borrowers in the market have pledged gold to get loans, or they have pledged gold to get the gold loans. And there is a potential question which could be asked by the UPSC here. Now first point is what? Henceforth in all those centers, the gold that is sold by the jewelers, the centers or those cities where AHCs are present, the compulsory gold hallmarking has to be done. Exceptions are these. Second, whenever you want to pledge gold in the market, please remember this, hallmarking is not compulsory. That is, the gold which does not have the hallmark, can you pledge even that particular gold and get a gold loan? Definitely yes. That has not been made mandatory by Reserve Bank of India. If you go under this particular Reserve Bank of India guidelines with respect to gold loans, it does not simply say that only hallmarked gold will be used for gold loans. No, even though the gold jewelry which is not hallmarked, can you pledge and get a loan? Definitely yes, it is allowed, and this is where UPSC will try to trap you. Then another point, what kind of gold jewelry with how much weightage or caratage can be hallmarked in India? Please remember the numbers also, 14 carats, 18 carats, 20, 22, 23 and 24. These are the caratages which sold in the market in the form of jewelry, right, will have to have the hallmarking as such. Done. So these are the gold hallmarking rules which have been announced by BIS very recently. Please be very careful. Now the last discussion in this particular week will be some of the points which are mentioned in the PIB but generally are not mentioned in the newspapers. Sometimes it so happens that the newspapers which you might be reading might not cover what is mentioned in the PIB, but definitely yes, UPSC might cover that. So for this particular video I have taken 4 points from the PIB which are important nevertheless. Okay. First one is VBSM. Virtual buyer and seller meet. VBSM basically stands for virtual buyer and seller meet. Now what is the context of this particular VBSM? Please understand, in the earlier videos we have come across one of the authorities such as APEDA or APEDA. Now understand this particular authority is involved in agriculture exports. Now because of the pandemic, what has happened is having physical meets is not possible. That is, for promotion of agriculture exports, generally what happens is the APEDA will organize these particular physical meets where the exporters, importers, food processors of different countries will come, will visit these particular meets as such, and based on their requirement they will try to import or export from different countries like this. But because of the pandemic situation this is not possible. But can we allow this particular pandemic as a reason to ensure or to allow our exports to come down, especially in the agriculture sector? So what APEDA is trying to do is, it is trying to come along with different embassies, that is Indian embassy from different countries, and it is trying to basically organize these virtual buyer seller meet. Is it okay? It is virtual, online virtual buyer seller meet. Very recently in the month of June, this VBSM was done for the buyers from Algeria. So basically more than 100 stakeholders, that is buyers, sellers, food processors, everybody was present within this particular VBSM and it was conducted. And this is not the only one VBSM which has been conducted. APEDA is conducting many of these particular VBSMs. Now in the context of UPSC, why this point becomes important? In what area this becomes important? If at all a question is asked, through what measures agriculture exports are being promoted even during the pandemic, and you want to provide certain fodder for these kinds of questions, here is the answer for you, or here is the point for you. Second one, TIWB, tax inspectors without borders. TIWB stands for tax inspectors without borders, just like the doctors without borders. This is a tax inspectors without borders. Please remember certain points here. TIWB is basically a joint initiative of United Nations Development Program, UNDP, and OECD. It is a joint initiative of both of them. Under this, basically they are trying to promote, implement certain programs in different countries and promote tax infrastructure or tax administration in these particular countries. Very recently this was there in the newspaper, that is the reason I have taken this particular point. Third one, enforcing contracts portal. Very recently Ministry of Justice, Ministry of Law and Justice has launched this particular enforcing contracts portal. Now context with UPSC, why it is connected to UPSC? Please understand, you must have heard of ease of doing business. Under ease of doing business, various parameters are taken. One such parameter is enforcing contracts, and India's performance in terms of enforcing contracts has not been very good, or to be more precise, it has been very bad. Now to address this particular issue, very recently Ministry of Law and Justice has launched this particular enforcing contracts portal. Under this, it will basically consist or it will provide a database or information related to what kind of new policies are being implemented by the authorities, what kind of laws are being implemented by the central government to basically promote the idea of enforcement of contract. And in addition to this, whatever commercial disputes or commercial courts which are handling these particular commercial disputes, the updation of the case within these particular commercial courts, the happenings in these particular commercial courts, all of this particular information will be available in this particular portal. So that is the importance of this particular enforcing contracts portal. And the last one, AIM iLeap. AIM basically stands for Atal Innovation Mission. Okay, under Niti Aayog there is a mission called as Atal Innovation Mission, and Niti Aayog has the duty of implementing this particular aim as such. Now very recently, for the first time, the fintech cohort was announced and conducted by this particular Niti Aayog or AIM Niti Aayog. What is the cohort? Group. The fintech grouping was done for the first time, and the name of this was given as AIM iLeap, and this was done for the first time. Basically during this particular cohort, what was proposed? These particular companies, technological companies, will come out with solutions for different problems which are faced by these particular corporates, and a platform will be provided where these particular fintech companies will come out with solutions and pitch it to these particular companies. So basically it is a meeting place for both of them, so that the contacts are generated, the business is developed like this. So for the first time, fintech cohort has been organized by Niti Aayog. The name of that is AIM iLeap. So remember this, more than sufficient. So these are the different articles as well as the questions related to these particular articles for this particular time period, that is 15th of June to 30th of June 2021. So at the end, I just simply want to say that if you like our initiative, please hit the like button. If you like the initiative, please provide it the same in the comment section also. And if you are not yet subscribed to the BYJU'S IAS channel, please consider subscribing to this particular channel. Thank you. Have a good day.